Hello, hello. Welcome. This is Wayne Belisle with this week's profit maximizing moment. Sorry we're a little bit late. Had to reconnect some stuff. Technicalities. Today we're going to talk about how taxes are a necessary evil, but more importantly for a business owner, something you should not be surprised of. Okay. I've had it. I've had people more than once be surprised. I mean, you shouldn't. I mean, as far as I'm concerned, every business owner should understand that taxes are the more you make, the more you're going to pay. All right. But still, nobody likes to get a surprise like 3 or 4 days before a deadline saying they owe $80,000. I've seen it, had it happen, not recently. And that's because of what I want to talk to you about, which is planning for the taxes and planning a way to reduce them as opposed to just, I was wondering what was going on. So I had the lights on. Anyways, it looked a little weird. Rather than just being surprised when it comes in, okay? And and I've seen it. You go, I feel your pain. I mean, I do my own, so but I have a pretty good idea. But even so, having look at the tax return and see how much you owe, and go, how is it this much? How I wasn't expecting this, and that can be a huge drain on your cash flow. All right. Truthfully, most business owners experience tax as a surprise every single year, without exception. Not because they're bad at business. In fact, if they were bad at business, they would know taxes. Let's be honest. Just simply because nobody's taught them the difference between preparing taxes, compliance, and managing taxes, tax planning. All right. When I'm doing tax returns, I'm in compliance mode. I'm looking at history. All right. I'm backward looking. It tells you, I'm telling you what's already happened and reporting it correctly. Tax management and tax planning is forward looking. The idea is to tell you what's coming so that we can plan for it before the end of the year, before December 31st. And I haven't, or whatever your year end is, for the vast majority of us, it's December 31st. Um, your business year, obviously, is what I'm talking about. Before then, there's a lot of different things we can do. And, it, it, quite a few. But after December 31st, like right now when I'm doing taxes for last year, there's not a lot we can do. All right. It's really something simple as that. All right. So if your tax bill that you get every year surprises you, that's not a tax problem particularly. That's a visibility problem. That's not having good books. That's a planning problem and not treating income tax like any other expense and managing it. Okay. Um, Most business owners only see the picture for their tax return or even their financial statements once a year at filing time. Truthfully, that's like checking your speedometer or your oil once a year and wondering, or truthfully checking your speedometer only after you get a ticket. No, I didn't realize I was going 90 miles an hour. So why? The common patterns I see is owners not looking at not having good bookkeeping, and not getting reasonably accurate financial statements monthly, at least quarterly. All right. Revenue is up and profits are up, but they don't realize taxes are going to go up too. They're not making estimated taxes or estimates based on last year instead of at least to avoid penalty. They're mixing personal and business spending, so true profit is difficult to figure out, if not invisible. And waiting until their CPA calls them in March, April, August, September, October, if you get extensions, to find out what happened. This isn't an issue of taxes. Again, this is an issue of not planning for it. It's an issue of not having good books so that you can see what's happening. When your profits are invisible, so is your tax bill. All right. So let's get a good understanding of the difference between tax preparation and tax planning and tax management. I like the two. We're planning and managing our taxes. All right. Tax preparation. When we're doing tax returns right now, we're in the middle of tax season. Corporate tax returns, um, S corporations and partnerships are due March 15th. Individual tax returns and C corps that pay tax are due April 15th. Now you can get a 6 month extension on both, but if you do and you owe money, the extension doesn't extend the time to pay the tax. It just gets rid of the penalty for not filing. So if you think you're going to owe money, you need to get it filed on time. But when we're doing it right now, we're looking at compliance. Our goal at this point in time is to get the numbers in the correct place, report everything correctly in a way that does not attract attention. And it's as simple as that. We're not really doing compliance. Now, I mean, we're not really doing planning. It's just compliance. But obviously, if we see something, we'll put it down and put it in our tax planning file. Tax planning, tax management is looking forward. It's understanding that your tax bill is exactly like every other, it should be. I'm assuming you're doing this, should be like every other expense you have in your business, something that you look at and manage. I have seen business owners spend way more time trying to save money on their phone bill than on their tax bill. And I'll be honest, when we're doing tax planning, the average tax planning client we have will save $30,000 to $60,000. Some much more than that. Some only as little as 10 or 12,000. I don't consider that little. That's money that's legally. And when we do tax planning and tax management, we're doing legal steps that the IRS has in the code that we can take advantage of. All right. And if nothing else, you know roughly what your tax obligation is going to be 6 to 8 months in advance. All right. This way you can make decisions with the tax liability in mind, and not as, oh my gosh, I owe $50,000 in a week. You know, and why is it every CPA is running up against deadline? Because we're buried. I mean, we do 600 to 700 tax returns, and the vast majority of them come in late February to late March. I mean, so yeah, can't possibly get to them all. So what does tax management look like? First of all, you need to know your monthly profits so that you know what your likely tax exposure is. I tell my clients, especially new businesses that are starting, they'll struggle, and then they'll do the hockey stick where they start to take off. I hate to see somebody who showed up in a brand new BMW or something, and I'm like, oh, they had a good year. Hope they put some money aside for taxes. And I tell them, if you see a dramatic increase in sales and profits, you need to call me in July or August so we can start seeing what we can do to minimize your tax planning. All right. Uh, they're not making estimate payments, or the estimates based on last year instead of this year, which is fine. I mean, that avoids the penalty, but you're not putting the money aside. Again, like I said, um, geez, I went to the wrong place. I like and I teach that I give a percentage. So, for example, for me, it's like 15 to 20% of what I collect is going to be in income tax, closer to 15. Somebody that's selling a product or manufacturing, that might be closer to 3 to 5 because they have higher cost of goods sold. Service industries technically usually around 15 to 20. Like I said, manufacturing, retail, wholesale is usually in the 3 to 5 area. So what I do is every time, I used to do it weekly. Uh, I do it now every 2 weeks, but at least weekly, I would look at what I collected in the last week or two, and I multiply it times the percent that I calculated before. And when I'm talking to business owners, this is something I've been teaching for a long time, giving them that percentage and adjusting it every year depending on what's happening. So I take that and I transfer that number. So if I collect $10,000 and I needed to 5% or 15%, then I'm going to move $1,500 at 15% to a tax savings account. All right. So I actually set up a savings account where I'm putting that in there. And then I'm paying my estimates out of that. I pay my final tax bill out of that. And if there's any left, I give myself a refund, take a vacation. Anyways. Because the difference between a business owner and a W-2 employee, you're not, we all have seen it. You're supposed to make 50,000, 100,000 a year. You're lucky if you take home 80% of that because Social Security, Medicare, and the income taxes are taken out, and you get the net. Well, that's because the IRS is taking out W-2s all throughout the year. So when you get a refund, all they're doing is giving you back some of your change. It's not really a gift from the IRS. Business owners, no, we don't have that. We're responsible for that. All right. So you need to do something like that. You need to definitely, if you're not getting tax planning, I don't get as many surprises because I'm swamped in October, November, December doing tax planning, which means people that have decent enough books where I can sit down and do an estimate, put it in a program we have that is AI run, basically looks at 1,600 different possibilities, kicks out some recommendations. I go through it and say, all right, these will work for this client, that won't, because I know the clients. And then meet with them where they come in. I've already done a projection for them so they can see what I think they're going to owe. And then we start going through the steps that the program kicked out and seeing, okay, what is the step, making sure they understand it, and how is it going to affect your taxes? And that's what we're looking at, okay? Um, that's important because think about what we're doing. We're actually planning and working on the tax return rather than being surprised, all right? When you manage taxes instead of preparing, something shifts. Tax becomes a signal, not a punishment. Yes, look, we're not going to eliminate your taxes. But I'll be honest with you, if you're making $200,000 and paying $30,000, yeah, you struggle a little bit. Make $2 million and your tax bill is $500,000 or $250,000 if we can take it down and reduce it. A lot less stressful. You just still don't like to pay the darn bill. Trust me, I'm with you. I don't like cutting the tax, but it's expected, and I know I minimized it as much as I could. All right. A higher tax bill, like I said, means a higher profit. That's not a problem. That's a sign of a business is working. The problem is when you don't see it coming, when you don't plan for it. What changes when you manage taxes? Well, like I said, you start to put the money aside. Because I don't know about you, if the money's in my checkbook, it must be mine. But if I've taken it out at the beginning and put it for Uncle Sam, who's a horrible tax partner, by the way, a horrible business partner, because he doesn't do anything, he just takes your money. Yeah, somebody on the other side will argue with me, but that's my opinion. Very little. There's things they do, obviously. Um, I'm not going to end up with this big surprise because I spent the money and now I got to scramble to figure out where to get it. I can make decisions now about equipment, hiring, investments, and factor in what the tax consequences are. Now, look, I'm one of those that don't think you should do any decision just only for the tax benefit. But if I was thinking about buying the equipment in January, February, March, and I've had a really good year in 2026, and I'm thinking about buying it in early 2027, maybe I accelerate it to this year. I'm going to buy it anyways. Figure out a way to finance it and pay it off if there was a reason. All right. Your owner's pay becomes more consistent because your profit is visible, and we make the owner's pay so that it's not ridiculous amount of Social Security and Medicare being paid. So, I'm not going to get into the details on that. But I've seen a lot of people where they just give themselves a raise and don't realize they're contributing to Social Security more than they should, more than they could justify not paying themselves, where they could take it out as an owner's draw. Not going to get into that right now. Something you should talk with your CPA or schedule a call with me. All right. Stress drops. The money's already saved. All right. And there's no surprises because even if I can't, maybe I just cut your bill by 20,000, you're still going to owe 120,000. Well, the 20,000 is nothing to sneeze at. But I'm telling a business owner 6 to 8 months in advance. All right. I don't know most business owners, if I give them a warning of that long with the time, they can plan on how to get it. All right. If they haven't been doing what I asked them to do. All right. But if you get a surprise, 5 minutes, 5 days, 5 minutes, might as well. 5 days before the deadline that I got to come up with $80,000. Very few business owners can pull that off. Some can, yeah, but they don't like it anyways because they had a plan for that cash besides that. So that's why we do tax planning. I don't like surprises. My clients don't like surprises. So that's what we're after. And look, taxes aren't the enemy. As simple as that. Confusion about what your profit is and an idea of what your taxes are going to be because you haven't managed to look at it. That's the enemy. You're not managing it. All right. But when we get to it, nobody likes it. Okay. Everybody hates the surprise. This is hard to fix alone, too. You need somebody who's been doing this with all the gray hair and been doing this a long time. And not necessarily. There's a lot of good young CPAs, too. But you need somebody that is good at taxes, not just preparing them, but planning for them. A simple question I ask is when somebody comes into me is, when's the last time your CPA gave you a tax planning advice or called you up? And I do this. I call up, we run every tax return that I do, business tax return we do through our program. And I'll call a client and go, hey, I think I got some ideas. Would you like to meet? I think I can save you $20,000, $30,000. Weird. Nobody's told me no. All right. If taxes surprise you every year, or you're still not sure where profit actually stands in your business, I'd be happy to talk. I have a couple of profit clarity call openings still this month, which I don't know how I'm doing this because it's a deadline. We're talking about 30 minutes, looking at your real numbers, and you'll leave knowing exactly where you stand and what you need to improve. It's very easy. It's waynebelisle.com/clarity. Just the words. Wayne Belisle, that's Belisle. You see my name down below on the screen. And .com/clarity, just like getting clarity into what your tax problem is. CLARITY. Hey, until next time. I need notes, otherwise I will go off on a tangent and never know what I was talking about. Until next time, this is Wayne Belisle saying, let's make this our most profitable year ever. Let's not send Uncle Sam any more than we're legally required to. The Supreme Court came out a long time ago. This was right after the income tax was put in place, saying there's a big difference between tax avoidance and tax planning. All right. Tax avoidance is illegal. Tax planning is legal. All right. So don't be afraid to do it. Say until next time, like I said, have a great weekend. God bless. See you in church. Take care. Bye. And we're out of here. And end stream.